Hey everyone, I'm Phil Hodgen and welcome to the February 23, 2024 Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month at noon Pacific time. Listen in online, that's what you're doing right now, or we post the show up later on YouTube and you can watch it then. This month's topic is episode 10 in the Form 5471 series, almost to the end, and it's all about the Section 962 election. So here's the series we've done over the course of between last April and now. We did a whole bunch on who is a filer. Then we went on to the income items. How does a U.S. shareholder extract income from a controlled foreign corporation in the form of Subpart F income, global intangible low-taxed income, and distributions, aka dividends. And we're now into the damage control. If you don't like the tax results of the CFC regime, what can you do about it? And this month we're talking about the Section 962 election, which in a nutshell says an individual can elect to be taxed as if he or she is a domestic corporation. Let's see what the numbers say on this. Next month, by the way, you can see tax performance comparison, CFCs versus other structure types. We're going to run the numbers side by side against CFCs with and without the Section 962 election and other ideas for Americans doing business abroad. And let's see what the numbers say. But for this month, here's the session. We're going to the intro, as always. There are four different things that the Section 962 election does. First two have to do with how much income is included in the shareholder's gross income. The second one has to do with the tax rate that included income is taxed at. We'll do a little mathematical interlude so you can see side by side what it looks like. We move on to the third election effect, which is that an individual is now allowed to claim the deemed paid foreign tax credit, Section 960. And then we'll look at what does that do, what's the mathematical interlude on that if we add in claiming the foreign tax credit. So the U.S. shareholder, a human, gets credit for the corporate income tax paid by the CFC. And then finally, we end up with, okay, now what happens if the CFC pays a dividend to the shareholder? How is that taxed, and what does it look like net across the board? And that's the mathematical interlude at number 9. And we wrap it up. So let's go. Introduction. In a nutshell, this is an election for individuals. Remember, the concept is that an individual gets taxed using domestic corporation tax principles. So, why would you give this election possibility to a corporation that already has the power? It affects the individual's Subpart F income and global intangible low-taxed income only. In other words, the income items that are coming out of the CFC and landing on the U.S. shareholders' gross income plate. It doesn't affect the U.S. shareholders' other income items. And as I noted in the table of contents, four things total. 3 are good, 1 is bad, and you're going to have to do the math for your situation to figure out whether it net saves you some taxes or not to make the election. So pretty picture time. Who makes the election? So it's individuals, either direct shareholders or through domestic pass-through entities, U.S. estates, and U.S. trusts. So there's the regs, and you can look at what it all means, but it's pretty straightforward stuff about who can make the election. This is a little summary. We're going to talk about each individual item separately as we go through. But the first row is how much of the income flows through to the U.S. shareholder. You can see without the Section 962 election, 100 cents on the dollar, both of Subpart F income and of global intangible low-taxed income will flow through to the U.S. shareholder for tax purposes. With the Section 962 election, I should say, the Section 250 deduction, which is ordinarily reserved just for domestic corporations, is activated so an individual can claim it, which means that 50 cents on the dollar of global intangible low-taxed income is now hitting the U.S. shareholders' gross income instead of 100 cents. So being taxed on half of your income is better than being taxed on all of your income, so net benefit for the Section 962 election. Second thing is, what about the tax rate? Well, without the Section 962 election, these income inclusions, Subpart F and Global Intangible Low Tax Income, are simply added to gross income. So whatever the taxable income tax rate is on that amount of taxable income it is, up to the marginal rate of 37%. By contrast, with the Section 962 election, the individual is taxed using domestic corporate principles, so the tax rate is 21% on those inclusion items. The third thing that the Section 962 election does is tax credits. You remember, tax credits are either allowed for tax that you actually paid or tax that you are deemed to have paid. So that's Section 901A. Well, a U.S. shareholder of a CFC, when the CFC pays foreign corporate income tax, did not actually pay those taxes, and the deemed paid foreign tax credit is reserved for domestic corporations. So without a Section 962 election, that corporate income tax paid to a foreign country by the CFC cannot be used by the U.S. shareholder on Form 1040 to reduce U.S. income tax liability. But with the Section 962 election, remember now we're treating the individual as if the individual is a domestic corporation. Now the individual is allowed to take the Section 960 deemed paid foreign tax credit. So now the individual U.S. shareholder, we pretend, has paid the tax that was actually paid by the CFC and is now enabled to take a foreign tax credit under the principles of Section 901. Subject to some limitations that we'll talk about in a little bit, but this is the usual kind of limitations that we're used to. Final thing, the dividends. Yeah, it's all well and good that the corporation has Subpart F income, has global intangible low taxed income, and we know how that flows through on Form 5471 up and through to the U.S. shareholders' gross income. But what about dividends? What happens when cash is paid out to the U.S. shareholder? Without the Section 962 election, when the dividend is paid out, the dividends are paid from earnings and profits that have been previously taxed, because the earnings and profits were included in the U.S. shareholders' gross income because it's Subpart F income or global intangible low taxed income. So Section 959 says you do not include the dividend a second time in the gross income of the U.S. shareholder. In other words, cash is free. We like that. By contrast, if you make the Section 962 election, that rule of Section 959 no longer applies, and instead the dividend paid is included in the shareholder's gross income, minus a little bit that we'll talk about. So we have converted a dividend from free money to taxable income, which is bad. Net investment income tax applies whether or not you make the Section 962 election, because net investment income tax rules have their own definition of dividends, quite apart from what it says in Subpart F, Section 901 through whatever it is, with the Subpart F income, the global intangible low taxed income, and all that fun stuff. Procedural stuff, just high level. It's a year-by-year election, so you make the election one year and don't the next. So this puts a premium on doing your math correctly and deciding whether it's to your benefit or not. It's an all or none election. So you can't pick and choose. If you are a shareholder in 3 different CFCs, it's all 3 or none of them. And finally, how do you do it? You make the election by attaching a statement to the tax return for the individual for that tax year. These are the things that I'm going to be talking about next month in March for the final episode in the Form 5471 series. But if you have a CFC and you do not like the Section 962 election, or you just want to do your homework and make sure you're picking the best choice possible, here are some other structuring possibilities for you as a U.S. person who has a business operation abroad that needs to be embodied in some sort of entity of some kind for business purposes abroad. You can make your foreign entity a pass-through entity by check the box, or for that matter, you could just form a partnership, foreign partnership, if that works for you. Next one is you could have a domestic corporation operating abroad as a branch in a foreign country. And ordinarily, I don't like this just because it creates a lot of bureaucratic headache, quite frankly. I mean, it just if you walk into a U.S. bank with a foreign corporation and you're just an average Joe, you're not some kind of muckety-muck high roller, you're going to have a hard time opening a bank account. So will the same thing happen if you walk into a bank in the Netherlands with a U.S. corporation and say, hey, I want to do business here, can I open a bank account? I don't know. But I've been told that the Netherlands in particular is not such a bad place to do this kind of thing. So maybe you just look country by country to see whether this is a viable alternative for you. The next one is parent-sub relationship. So create a holding company, let's say in Delaware, that owns the CFC, so that rather than having an individual shareholder of a CFC, you have individual owns domestic C corporation, which in turn owns CFC. Another way is, remember, only U.S. shareholders have this problem, so don't be a U.S. shareholder. Get down to 9.9%. Or, conversely, only problems arise from controlled foreign corporations, not regular corporations. So make it not be a controlled foreign corporation. So make sure that it's not more than 50% owned by U.S. shareholders by voter value. And the final one is the high tax exception, where if the corporation is doing business in a country with high enough corporate income tax rate, you can make the high tax exception election, and that prevents the flow through of Subpart F income and global intangible low taxed income to the U.S. shareholder, and it just behaves like a normal C corporation for the most part. Any of these might be possibilities for you. But having looked at that, and we'll talk in detail about those next month, let's start looking at the 4 effects that the Section 962 election has. First one is it reduces the Section 951 income by 50%. First rule, there's this thing, the Internal Revenue Code Section 250 deduction. It just says if you have a global intangible low taxed income inclusion, you have an automatic 50 cents on the dollar deduction. The end. But only if you're a domestic corporation. The Section 962 election specifically enables an individual to claim the Section 250 deduction, which means that the individual can now take the 50 cents off deduction in computing income tax liability from global intangible low taxed income. The deduction does not apply to Subpart F income. So here's the code excerpt. So domestic corporation, and that's the most important thing. The deduction is reserved for corporations only, and you can say it's 50% of global intangible low taxed income. For years after calendar year 2025, that's going to drop to 37.5%, but here we are right now. So in beautiful little pictures, this is what it looks like if the CFC throws off some global intangible low taxed income. It's included in the shareholder's gross income, and there's no deduction, so it flows through unfettered and undiminished to the individual income tax return. By comparison, with the election, the Section 250 deduction takes 50% of the global intangible low tax income off the table. So gross income is 100 cents on the dollar, taxable income is 50 cents on the dollar, and we like that. Now, just to show you the sort of procedure, how the numbers flow through the tax return, At the top, you can see how the numbers start on the far left as Schedule I-1 of Form 5471. This is for global intangible low-taxed income. You take it over to Form 8992, Schedule A, which is the form that aggregates all of a CFC, a U.S. shareholders CFC global intangible low-taxed income numbers into a single number. And then from Schedule A, it ports to Form 8992 itself, where it computes the global intangible low-taxed income, which is the inclusion amount. You take that inclusion amount, you put it on Schedule 1, which is one of those newfangled sidecars that goes on to the Form 1040, and that's the additional income. And then from Schedule 1, it goes on to Form 1040 as part of the gross income. And then, standard deductions and all that fun stuff happen, and you end up with taxable income, and then you compute the shareholders' income tax liability. Critical thing to see here is that the global intangible low-taxed income drops straight into Form 1040 into the gross income of the individual taxpayer. Compare that to the little diagram on the bottom, and this is with the Section 962 election. This is what happens. Again, we start with with the Form 5471 and the Schedule I-1. So you do your numbers there. You port them over to Schedule A, and then from Schedule A to Form 8992. And again, we have our income inclusion number. Now, that income inclusion number you port over, you see the blue box to the right, goes to a Section 962 statement that you get to make up freestyle, but it gives the government a summary of all of the income items and all of the deductions, how it was computed and how the tax was computed. And you can see on the upper row there, the little blue box that says Internal Revenue Code Section 250 deduction. It's a simple calculation. You take your global intangible low-taxed income inclusion number, put it on Form 8993, divide by 2, and there's your deduction. And that number then is ported over to your Section 962 statement. The combination of all of that will add up to some taxable income. You'll apply the 21% tax rate to it, calculate a tax liability, and then you dump the tax liability directly onto line 16, which is the shareholder's income tax liability. And it's one of those little, there's a checkbox with a little blank, and you check the box and you say this comes from 962 election, and then you put the total tax liability on the line to the right of it. So that's how it works. So the critical thing is, instead of the global intangible low-taxed income dropping onto the 1040, it sort of takes this little side detour onto this statement that you make up, and then you put the end result, the tax liability, onto the income tax return. The income is still included in the gross income of the taxpayer. It just doesn't appear on the face of the Form 1040. Just the end result, the tax liability, shows up on line 16. So, simple stuff. Section 250 doesn't apply to Subpart F. Section 962 allows an individual to make the Section 250 deduction. And the moral of this story is, as you're starting to eyeball your particular situation and decide whether the Section 962 election makes sense or not, if you have a corporation that's basically throwing off only Subpart F income, you're losing one of the major benefits of the Section 962 election, namely the Section 250 deduction, and it may not make that much of a difference to you. So if you have a CFC that has heavy generator of global intangible low-taxed income, you're more likely to be interested in the Section 962 election. All right, so we've seen that in some cases you get 50 cents on the dollar deduction against the global intangible low-taxed income inclusion that hits the U.S. shareholders' gross income. That's great. Let's look at the second thing. What happens when that income hits the gross income amount? How is it taxed? What's the tax rate? And the answer is, instead of ordinary tax rates for individuals, which is Internal Revenue Code Section 1, you're instructed to use corporate income tax rates, which is Internal Revenue Code Section 11. So here's the magic language from Section 962A1. So you calculate the income tax under Section 11. And what that means is not only are you going to use the income tax rate that's in Section 11, which is 21%, but you're also going to calculate taxable income as to these income items the same way a corporation would, not the same way a human would. So this is why the global intangible low tax income and the Subpart F income for someone who makes this election does not hit the face of the Form 1040, because it has to go over to a sort of side computation where you're applying corporate tax principles in calculating the tax liability. So if you look at Section 962A1, it says it applies to Section 951A. Well, that's Subpart F income, but it was written long before global intangible low taxed income even existed. But the regs make it clear that the same principle applies to global intangible low taxed income. And it applies to this thing called a Section 78 deemed dividend, which we'll talk a lot more about when we come to the deemed paid foreign tax credit. Now let's do some quickie math. This is a simple model to just show the impact of the Section 250 deduction and the handy new tax rate. So there's a column, no Section 962 election. That's just plain vanilla. What if you do nothing? And then on the right, Section 962 election. So let's start assuming that the CFC generates $600,000 of gross income inclusion. And we're saying, okay, well, how much of that is going to be taxed? Well, let's say, first things first, the Section 250 deduction. Not allowed for an individual, but is allowed for the Section 962 election, so negative $300,000 on the right-hand column. And that results in the net global intangible low tax income inclusion amount of everything for someone who just makes no election, or $300,000 of income for the person who makes the Section 962 election. Next, now that we have sort of gross income, net gross income, whatever you want to call it, now we have to go from that number to taxable income. Well, a human being gets a standard deduction. Let's just take the 2024 single taxpayer standard deduction of $14,600. Taxable income, $585,400. Average tax rate is just shy of 30%. That means the income tax liability on that $600,000 of global intangible low taxed income is going to be $175,265. By comparison, let's go over to the right-hand side. The gross income amount after the Section 250 deduction is $300,000 for someone who made the Section 962 election. A corporation does not get to take a standard deduction in computing corporate income, so not applicable, which means taxable income is $300,000, 21% tax rate, tax liability $61,000, big savings, $112,265. So this is this gets the people in the door. This is your loss leader. Come on down, everybody. This is what attracts people at first blush for the Section 962 election. Here are the footnotes, where I derived all these numbers and why. Here is the worksheet, the calculation. These are the 2024 brackets for a single person. Shows how I came up with $175,265 and 30% average tax rate over all the money. Actually is like 29.939393993, but 30% for you and me. So now we've seen the effect of the first two items. Let's look at the third one, which to my mind is the biggest and the best, because it basically solves the problem of this artificial inclusion of a CFC's income on a personal income tax return, and that is the deemed paid foreign tax credit. Without the Section 962 election, there is no deemed paid tax credit. And the reason is because, remember, Section 901, which is the foreign tax credit rule, says you're allowed a credit for taxes you actually paid, foreign taxes, or foreign taxes that you are deemed to have paid. And the only people that can claim the deemed to have been paid foreign taxes are domestic corporations. And humans aren't corporations, therefore, too bad for you. And so what that ends up meaning is that this corporate income gets taxed once, in my little example, in Canada. Canadian corporate income tax is paid, and it gets taxed again in the United States when it's included on the personal income tax return of the U.S. shareholder. That is bad. But the Section 962 election allows this U.S. shareholder, remember, we now pretend that the U.S. shareholder is treated like a domestic corporation, so now the domestic corporation rule, which says Section 960 is enabled, deemed paid foreign tax credit is allowed, will work for the U.S. shareholder, and this U.S. shareholder can take the Canadian corporate income tax paid and apply it as an offset with a foreign tax credit against the U.S. income tax liability derived from the inclusion from the CFC. So this reduces the tax liability substantially, and you'll see this as we go further. I've referred to Section 901 a few times, so here's the language, and you see the bolded stuff. In the case of a corporation, taxes deemed to have been paid. So this is why it's so important to use the Section 962 election, because that toggles this on for a human individual who can now pretend that he or she is a corporation. So this slide only exists to show you the reference in Section 962 that explicitly calls out and says that an individual making the election can use the Section 960 deemed paid foreign tax credit. Now, for those of you who have, I don't know a lot about foreign tax credit, but I know some, and even people like me who know something know that there's some limits on how much you can claim. And the ordinary limit that you worry about is the limit of the lower of what you actually paid on that income item in the United States for U.S. tax liability, or the actual tax you paid to the foreign country. And so whatever the lower of those two, that's the amount of tax credit that you're allowed to take. And that's Section 904. But there's a second limit specifically for global intangible low-taxed income only, not for Subpart F income, but for global intangible low-taxed only. And that's the upper row of little boxes with arrows. And there are actually two limitations. The second one is the one I just mentioned, but the first one is that for computing the foreign tax credit deemed paid, you're only allowed to take 80% of the amount of tax that the CFC actually paid. So if the corporation paid $100 of foreign corporate income tax, for purposes of computing the U.S. shareholders' deemed paid foreign tax credit, you're going to have to use 80. And you're going to take that $80 and then you're going to move on to the next step, which is the lower of the tax deemed paid or the U.S. tax liability on that income item. And the output of that calculation is going to be the tax credit that you're allowed to take. So why the 80% is there, I'm not sure. From memory, watching it all happen in late 2017, it's a bunch of politics, as you might guess. And the way that you do this is you attach Form 1118, the corporate foreign tax credit form, to an individual income tax return. Hey presto, this is kind of fun, huh? So you may end up with an individual income tax return, let's say for an American living abroad, with Form 1116 and that which individual foreign tax credit, and 1118 for the tax credit that we're talking about right here for the deemed paid foreign tax credit. So the side effect, remember I talked about, just as an aside, the Section 78. There's a deemed dividend, and it's a gross up. And here is the code section. If you claim the deemed paid foreign tax credit, you have to gross up the amount of flow-through income to you from the CFC by the amount of the tax paid by the CFC. So if you'll see in my examples later, let's assume we have a CFC with $600,000 of taxable income and it pays $200,000 of corporate income tax liability to a foreign country. Well, you have $400,000 left over after tax, but the flow-through of the global intangible low-taxed income is going to be that $400,000 earnings and profits plus a gross up of $200,000, which is the $78,000 deemed dividend. And the important thing to remember here, you gross it up by 100% of the tax paid by the CFC, even though you're only allowed to use 80% of that for the deemed paid foreign tax credit. So you're actually getting back more in income than you're allowed to take into consideration for the foreign tax credit calculations that you're going to do. So having given you these sort of abstract ideas, let's put them into numbers and let's do a little walkthrough. These numbers are taken from the spreadsheet that I handed you. The spreadsheet goes on and on and on and on, so I've just abbreviated and summarized here. But let's start from the first with computing the shareholders' gross income inclusion. So we have a CFC with, let's just assume, $600,000 of taxable income. We have 20% tax rate in the foreign country, so the corporation is going to pay 20% corporate income tax, $120,000. Left over with $480,000, so that's going to be current earnings and profits. Remember, because you start with, earnings and profits, the general concept of that is as a proxy for how much money is on hand so you can pay a dividend if you want to. And the answer is they got $600,000 in, paid $120,000 out in tax, and they got $480,000 left over that they can pay out in dividend if they feel like it. So those are the numbers. And if we have no Section 962 election, what do we have in terms of a gross income inclusion? $480,000. So this is, put your hat on and look at it another way. This is taking a tax as a deduction rather than a credit. Section 962, we're going to claim the deemed paid foreign tax credit under Section 960. We start again with the $600,000 of taxable income, pay $120,000 of foreign country corporate income tax. Again, $480,000 left over, current earnings and profits, available for a dividend in theory if they wanted to distribute the cash. But for calculating the shareholders' gross income inclusion from being a shareholder of this CFC, we add back the $120,000 as a deemed dividend. So the total gross income inclusion for the shareholder is $600,000, against which a foreign tax credit will be claimed. Next step. Now that we know what the inclusion is going to be, either $480,000 without the election or $600,000 with, let's calculate the shareholder's tax liability before the foreign tax credit. We go down the next step. We say, is there a Section 250 deduction? Yes, no. No, if you don't make the Section 962 election. Yes, if you do. Is there a standard deduction? Well, yes, for a human without the Section 962 election. No, for a human with the Section 962 election, because the human has put on the coat that looks like a domestic corporation and now is parading around as if it's a domestic corporation, and that's not allowed a standard deduction. Result, shareholders' taxable income before the foreign tax credit is $465,000 without the election and $300,000 with. We compute the tax liability either as ordinary income, which results in $133,265 for no election, or $63,000 with the election. And this is the difference in the tax rate, 21% versus for the election versus whatever ordinary income is taxed at on the other. Next, now that we know the tax liability, remember that foreign tax credit allowable is the lower of actual U.S. tax liability on that income item versus what was actually paid to the foreign country. So now we're going to calculate all that out. Without the Section 962 election, the credit's not allowable, so that column is blank. With the Section 962 election, we're going to do the calculations, the two limitations. So the first limitation is the 80% limitation of Section 960D, 120,000. 80% of that is 96,000. So that's deemed paid to the foreign country by the U.S. shareholder. Actual tax liability on the income inclusion is 63,000. The min function, next line down, what's the smaller of 63,000 and 96,000? Well, 63. Therefore, the Section 901 deemed paid foreign tax credit allowable at the bottom is 63,000. Let's see what it does to the overall shareholders' U.S. tax liability net of foreign tax credit. For no Section 962 election, there is no tax credit. Therefore, the original calculated tax liability of $133,265 stands. With the foreign tax credit, the income tax liability on the global intangible low tax income pass-through is entirely offset by the foreign tax credit allowable. So the net effect of having Section 951 Cap A for this U.S. shareholder is a big fat zero in tax liability and a big fat $8,000 or $10,000 of accounting fees for Section 5471 and assorted hoo-ha, or potentially more. Side note, I have talked to a lot of you about 5471s and how much you charge, and I'm just stunned at how underpriced you are. This is a lot of work. It takes a high degree of skill. It has a lot of latent liability built in for you for malpractice. I don't know why you're not getting compensated for all of that. So my secret plan for all of you is raise all of your prices on your Form 5471 jobs by $1,000 starting tomorrow. More, but let's just start there. If you want to call me and talk to me sometime, we'll talk pricing. Finally, worldwide tax. Let's just see what the total load looks like for this U.S. shareholder having a foreign corporation doing business abroad and facing two sets of taxing jurisdictions. We had foreign corporate income tax paid of $120,000. Without the election, we had $133,000 plus of U.S. income tax for the individual. So $253,000 plus of total worldwide tax paid on this $600,000 of taxable income for an effective rate of 42%, as compared with the person who made the Section 962 election, where the only tax load is the foreign corporate income tax liability. Well, sweet, I know what I'd prefer. So again, so far so good. The Section 962 election is looking really capable, and we like it. And in general, I'm going to guess that when you do the math for your CFC and you're trying to decide whether it works pretty well, I'm going to guess that the Section 960 deemed paid foreign tax credit is going to offset most or all of the income inclusions that flow upstream to the U.S. shareholder's income tax return. So this is not an anomalous example. This is pretty standard. So election result, the final one. Dividends are no longer tax-free. So this is the bad one. First things first, the income tax. The election makes dividends mostly taxable for income tax results. And the summary here in a slide is without Section 962, the operative provision is Section 959, which says when you have a distribution of previously taxed earnings and profits, it's not included in gross income of the shareholder, and it's not a dividend. So go away, just take your money, and it doesn't do anything to your U.S. tax liability. And then my little parenthetical saying, yeah, but don't forget net investment income tax, where dividends are dividends regardless of Section 959. With the Section 962, Section 962 says 959 doesn't apply, go away. And it says distributions are included in gross income of the shareholder, so you're going to get dividends over and above the actual tax liability that you paid on the inclusion, like the global intangible low tax income we just saw. That if you pay tax on it, you get to reduce the E&P by that amount, but everything above it is taxable. Well, remember my previous example where the tax liability was zero, which means in that corporation, 100 cents on the dollar of any dividend is going to be a dividend with the Section 962 election. So, just so you look at the code, Section 959, what does it say? It says, when you have earnings and profits which have previously been included in the gross income of a U.S. shareholder under Section 951A, so that's subpart F, but it's been extended to global intangible low tax income as well, it says, shall not, when distributed to the such shareholder, be again included in the gross income of the shareholder. So that's the blanket statement that you get free money if you don't claim the Section 962 election. With the Section 962 election, here's the critical thing, again bolded, notwithstanding the provisions of Section 951A1. Okay, so saying 959 is off the table, so that exclusion is off the table, and it's saying it shall be included in gross income to the extent of earnings and profits exceed the amount of tax paid under this chapter, so that's Section 951 little a in parentheses subpart F income, or 951 cap A, global intangible low taxed income. So now you have all of a sudden dividend income that you did not have before. And the dividend income will either be qualified dividends or ordinary dividends, depending whether a foreign corporation, if it's in a country that qualifies for the qualified dividend, yay. If not, you're going to pay as ordinary income. And just at a high level, this is how it's going to work. And I give you this from the regulations for Section 962 just to tell you that if you thought tracking earnings and profits was painful before the Section 962 election, now you're going to have additional buckets of earnings and profits that you're going to have to track for determining when you have a distribution from previously taxed earnings and profits, whether it's included or excluded from gross income. So you start with calculating Section 962 earnings and profits, and that's basically earnings and profits earned in a year where you make an election. The excludable Section 962 earnings and profits is equal to the amount that federal income tax that you actually paid on those inclusions. And then that equals taxable Section 962 earnings and profits, which is your dividend income on Form 1040. So a little bit more brain damage, because we always love brain damage in terms of more buckets to calculate and more things to track. But here you go. Section 962 came about in 1962. And here from the what do they call it, legislative history, where they're explaining what they did. A little quickie example. One of the things to note is at that point they thought it was reasonable for an example to quote the marginal tax bracket of 52% for an individual. And so you have a distribution of $100 when the money was previously included in gross income. Well, you take the 52 away from the 100 because that was the tax liability. You paid $52 when you had the earnings and profits included. And so you only get taxed on the remaining 48. So If we think 37% is bad, remember these were the good old days in the early 60s. All right, net investment tax, just an aside. Just because we have a dividend from a CFC that is either excluded from gross income if you don't make the election, or included in gross income as a dividend if you do make the Section 962 election for income tax purposes, you're still going to have to pay the magic 3.8% on that, because dividend is dividend. And the net investment income tax is in a completely different segment of the Internal Revenue Code with its own set of rules and its own set of the tax base, which is net investment income, which is a completely different definition. It rhymes, but it's not identical to gross income for income tax purposes. And so they say dividend is dividend. We don't care if there was an exclusion in the income tax portion of the Internal Revenue Code that made this distribution not included in gross income. We're going to treat it as a dividend anyway for net investment income tax purposes. Let's wrap up by looking at a combined effect of all four of the tax impacts that the Section 962 election makes. So the Section 250 deduction, so half as much global intangible low taxed income, lower tax rate, using the deemed paid foreign tax credit on the individual tax return, and then finally the bad stuff that happens to dividends paid by the CFC to the shareholder. This just summarizes the long spreadsheet that I handed out to you as part of the presentation, so you can download that from the CalCPA website. And the assumptions briefly are $600,000 of net profit at the CFC level. The CFC pays 20% foreign income tax, so $120,000. $480,000 is left over in the bank, ready to be distributed as a dividend to the shareholder. And let's just assume that the shareholder is living in a foreign country and pays 40% personal income tax on the dividend income received. I'm going to treat this as an ordinary dividend for U.S. income tax purposes, because it makes the model that much simpler to build. And again, refer for the details to the spreadsheet. Here's the quickie summary. So for this corporation and those assumptions, $600,000 at the top of taxable income, everything is distributed out. Whatever is left over after tax is distributed to the shareholder, so the shareholder can go walk outside, buy a hamburger. $480,000 is better be a good hamburger. We have at the top, under all three models, no Section 962 election, or the middle column, make a Section 962 election but do not use the deemed paid foreign tax credit. Remember, tax credit is optional, not necessary. And the third column on the far right is make the Section 962 election and do indeed use the deemed paid foreign tax credit. So we see in all three cases, foreign corporate income tax is what it is, and it applies across the board as would be expected. Next, we have the impact of the inclusion of global intangible low taxed income, and for the model that shows the deemed paid foreign tax credit taken, the Section 78 deemed dividend. So without the Section 962 election, you see the worst possible case. We have $480,000, which is the global intangible low taxed income, earnings, and profits for the current year, decanted onto the Form 1040 as ordinary income, and $133,265 is the tax liability. For the situation where the Section 962 election is made, but we're not taking the deemed paid foreign tax credit, we have a tax liability of $50,400. Now, why is that? Well, what you're seeing there is the effect of 50 cents on the dollar deduction by Section 250, which takes the amount of income down to 240,000 instead of 480, and then the impact of the 21% tax rate rather than the average 30% tax rate on ordinary income that shows up on the Form 1040. So that's the combined effect. On the far right, what do we have? We have $63,000 of tax liability on the inclusion, because this takes into effect the fact that we had a deemed dividend under Section 78 put back into gross income in order for us to later take the deemed paid foreign tax credit. So that you're seeing the effect of the deemed paid foreign tax credit grossing up the income and therefore grossing up the global intangible low taxed income U.S. tax liability for the shareholder. Next, shareholders' foreign tax credit against the global intangible low taxed income. Well, if you're not making the election, there is no credit allowable, right? So that's column 1. Column 2, we're saying, yeah, the credit is allowable, but the taxpayer has elected not to use that benefit. And on number 3, we have the effect of the foreign tax credit allowed under Section 960, the deemed paid foreign tax credit, where the human shareholder takes a credit for the tax paid by the CFC, $63,000. And the reason for that is simple. Remember, Section 904 in the foreign tax credit rule says you are allowed to take a foreign tax credit which is the lower of your U.S. tax liability or whatever you paid the foreign government. And in this case, what you paid the U.S. government is less, so we're taking it. Conveniently, it completely nets out the tax liability on Section 951 Cap A income. So yay, so it functionally is a zero. Next, we go down to the human level. Shareholder pays personal foreign income tax on the dividends received, $480,000, remember? And we are assuming that it's just a 40% across the board, so because that money goes to a foreign country, it is what it is across all 3 scenarios for U.S. tax purposes. Now we look at the shareholder's U.S. income tax liability on that dividend income. And if you do not make the Section 962 deduction, so that's the left column, that dividend is not income, and that's the effect of Section 959. So yay, no tax liability at all because there's no gross income. If you make the Section 962 election, that dividend income is dividend income because now the controlling code section is 962D, like David. And that says that a dividend from previously taxed earnings and profits will be included in the shareholder's gross income, except for the amount but only the amount above what the income tax was paid on that income exclusion item. So remember, just in the same column in the middle, the income inclusion from Section 951 Cap A caused a $50,400 income tax liability. So $480,000 minus $50,400 equals whatever it equals. And this is ordinary income. And the computed income tax on that amount of ordinary income is $132,126. So that's what the dividend from the CFC is going to cost in income tax to the shareholder, U.S. income tax. And then finally on the right, we see $151,870. Now why is that? Because Section 962 little d in parentheses says you include the entire distribution in the gross income of the U.S. shareholder, because 959 no longer applies, and you only include the amount over and above the U.S. tax liability on the 951 Cap A inclusion. Well, look above, you had $63,000 liability offset by $63,000 of foreign tax credit. So the tax liability paid by the shareholder is exactly bupkis zero, and therefore the entire $480,000 of dividend income is included in the gross income of the shareholder, and that's $151,000. $1,870. All right, so far so good, so bad. Let's go down to the foreign tax credit. Remember, this is the shareholder received a dividend from a foreign corporation, and the foreign corporation taxed the shareholder on that dividend income. So this is a foreign income tax that's directly paid by the shareholder. So Section 901 says that the shareholder is allowed to claim a foreign tax credit. How much? Well, on the left, no Section 961 no Section 962 election. Zero foreign tax credit on the dividend income. Why is that? Because remember that there's a limitation on the amount of foreign tax credit allowable, and it's the lower of the U.S. tax liability on that income item or the amount actually paid to the foreign country. The amount actually paid to the foreign country was $192,000. The amount paid to the United States of America was zero because this distribution was not a dividend and therefore was not taxed at all. Therefore, the foreign tax credit is zero, but we don't care because the income tax was zero too, so everything works out just fine. Let's look at the middle column, which is the Section 962 election is made, but the taxpayer did not elect the deemed paid foreign tax credit. What happens there? Well, again, the shareholder directly paid $192,000 of foreign income tax, and Section 904 says you are entitled to a tax credit equal to the lower of what you paid the foreign country or what you paid the United States. And in this case, what you paid to the United States on that dividend income was $132,126. There's your foreign tax credit. Completely offsets the tax liability on the dividend income. And finally, on the right, we get the same thing, exactly matchy-matchy offset. So because the foreign tax paid by the shareholder on the dividend income was $192,000, the tax liability on the dividend income, remember the entire $480,000 was included as a dividend because of Section 962D, but the lower of U.S. or foreign tax is the U.S. number, which is $151,870. Again, completely zeroing out the U.S. tax liability on the dividend income received. So if you look at the dividend treatment right across the board, you can see in all scenarios, it's a big, giant nothing burger. The tax liability on the U.S. income tax return is completely zeroed out. In the case of someone who doesn't make the Section 962 election because Section 959 says so, and in the case of the person who does make the Section 962 election, because the foreign tax credit is going to take care of the tax liability as long as the foreign tax rate is higher than the U.S. tax rate. So I used the ordinary income rate, and I carefully picked a foreign tax rate, 40%, higher than the possible maximum U.S. tax rate of 37%, just to make this math look beautiful to you, and so I could explain this scenario. And then finally, net investment income tax is net investment income tax. Basically, the net investment income tax rules are in a completely different chapter of Subtitle A of Title 26, so they're their own little thing, completely divorced from whatever the income tax rules say. And both because they're in their own chapter and because the regulations under net investment income tax say so, you completely ignore the rules like Section 959 that say this is not a dividend. And the net investment income tax rules say, oh, yes, it is. And that's actually in Regs 1.1411-10 somewhere. So you're going to have the 3.8% net investment income tax on a dividend paid from a CFC, whether it's from previously taxed earnings and profits or untaxed earnings and profits. And you can see at the very bottom row the total worldwide tax load on fully distributed income. So $600,000 came in at the top of the CFC, the taxable income, And at the end of the year, there's zero money left in the CFC because it either went out to taxes or it went out to a dividend to the shareholder, and then the shareholder paid taxes. And this is what the tax load looks like. Worst case is no Section 962 election. It's better if you make the Section 962 election under my fact pattern, and it's even better if you also claim the deemed paid foreign tax credit. And again, I commend your loving care and attention to the big Excel spreadsheet that accompanies this slide. And with that, we come to the conclusion, and as you can see from the way I described my little model, I have a hunch that when you do your math, if your taxpayer is living in a high-tax country where the tax rate on personal income tax is going to be the same or higher than it would be on dividend income in the United States, and if the corporate income tax is right around or higher than the income tax liability, what you're basically looking for is you're looking for the offset of the global intangible low-taxed income or Subpart F income inclusion. You want that to be completely offset by a foreign tax credit. And so if you have a corporate income tax rate sufficiently high in that other country, that's going to happen because the deemed paid foreign tax credit is going to do an offset of the U.S. income tax liability on the shareholders' tax return from the 951 Cap A income inclusion. But again, you won't know until you run the numbers, so run the numbers. And that's all. See you next month. Next month, the March edition is episode 11 of the Form 5471 series. We wrap it up with a side-by-side calculation of tax liabilities for a bunch of different scenarios. This little spreadsheet that you got this month shows you 3 of them. We're going to have a lot more, and we're going to see what the last man standing for the best choice of an American human being doing business abroad will look like. Thanks so much.